All right, Trader Boys gangs, we had a little conversation going yesterday about the trade on ZM that Jordan executed and looking at, instead of trading the stock, trading the options on it. So Jordan did an example there, trading 10 shares, 420 entry, so $4,200 investment to get in and exiting around the 480 mark. So 420 down here, 480 mark up the top here, and looking at making $500. So if you're trading the one contract in the option, one contract in the option is controlling 100 shares of stock. So your risk is going to increase as well as the reward's going to increase. Now, a lot of you have been trained and educated, risk 1, 2, or 3% of your account. When trading options on smaller account sizes and you have proven consistency, we can actually eliminate that rule. And the reason being is you got proven consistency, and all we're going to do now is leverage that consistency because you're doing exactly the same thing, same entries, same exit, same rules, just applying the option contract instead of trading the stock. Your risk will increase, but so will your profits. So you've got to have that proven consistency before leveraging, and that's really, really important. So, from all the transactions I've seen Jordan executing on ZM here, he definitely has that and is ready for this transition to go to the option contract instead of trading the stock. So here's what we're looking at. From everything I can see from the screenshots, he got in on around the 24th. Now, with Thinkorswim here, utilizing ThinkBack, we can actually go back in time and look at what the option contracts were. Now, the limitation on this is the pricing of the options at close of market. So this is going to be as close as we can get, but gives you kind of an indication of what it would have been. So think of the 24th here. This is when Jordan would have got into the trade. He got in around the 420 mark here. We're going to be looking at the close of market, which the stock was trading at 427. Then on the 24th here, that option contract would have been $37.05 per share. So this would be a $3,700 investment. So instead of trading $4,200, you'd be looking at roughly around $3,500 at the 420 mark. But we'll go with 37, so gives you kind of an estimate, pretty close, what we're looking at. So entry would have been $3,705, so $3,705 would be your total investment into the transaction. So 10 shares of stock is a higher investment than what one contract in the option would be, controlling 100 shares. So now your risk goes up as well. Now here's kind of the cool thing. What controls a huge factor of the option premium, the 3705, is what we call delta. And the delta is a rate of change of the option premium. So for example, if you have a delta of 0.50, think of it at 50 cents. If the stock goes up $1, you make 50 cents. Okay, so for every $1 move of the stock, right, your delta determines how much the option premium is going to move. So if the stock goes up $1, you make 50 cents. Stock drops $1, you only lose 50 cents. So you've got that parameter on the upside and the downside. Now, the way options work is what controls the delta is called gamma, and gamma is the rate of change of the delta in relation to every dollar movement in the stock. So what happens is when the stock moves in your direction, in this case in the upward direction, the delta is increasing by the gamma, which increases your rate of return. Right? So it actually creates a compounding effect, where when the stock moves against you and you start to lose money, that delta decreases by the gamma, and for every dollar drop, you lose less and less on the option contract. So you're actually decreasing risk on the downside and increasing profit potential on the upside. So this is a very powerful aspect of options. So right in here, we're looking at getting the entry on the 24th, trade all the way up. The example we're looking at there was exiting at 480. The closest we're going to get is an exit at 477. Right? So here's what we can do, is we can go day by day. So we're looking at one contract here of the December 4th. Okay, so there's 11 days to expiration in this contract. You can see that right here, 11 days to expiration, right, of the 420 call. So we have the right to buy the stock at 420. Right, so on the 24th, we would have paid $37.05, right, and we changed the date to the 25th here. On the following day here, the 25th, market closed with an $800 profit. Right, so you can see delta's gone up to 65, increasing by the gamma. Right, now we move to the 26th, okay, which was the weekend, 27th. 26th was Thanksgiving, market close. 27th, we're at $2,715, okay, and we keep going to the 28th, okay, which was another non-moving day, probably the weekend. And then looking at the 30th, okay, 30th, right here, okay, there's your 30th, coming through at 480. Okay, so this is going to be based at 477. so $3 lower, but you would be sitting at probably about a $3,100 profit, right? So you took a $3,700 investment with a let's call it a $3,100 profit. That's a pretty good trade in comparison to a $4,200 investment with the stock of 10 shares and a $500 profit. Right, now, next thing we're going to look at is the risk on the downside. So if we come back and we look at the 24th, right, we had a delta of 57. So what you look at is roughly about a delta of 50. I don't have the gamma up here on this setting, but if we had a delta of 50, and let's say you had, I'm not sure what your risk exposure was, but let's call it $10 risk on the stock, that'd be a $500 risk on the option contract, right? So now think of, $10 risk on the stock with 10 shares is only $100, right? Well, your risk went from $100 to make $500, or your risk on the option contract was $500 to make $3,100, right? So you can see your risk reward stays somewhat the same, but now you're thinking of, let's say you get a $10,000 account, you're risking $500 a trade. Is that okay? When you have proven trading statistics, it absolutely is. Because you're still going to take your losses, 500 here, 500 here, 500 here. You'll have those drawdowns, but then when you hit your winners, right, and you have those big pops, your account will do the same thing at just a more exaggerated pace. That is the only difference. So you've got to have those proven trading statistics. Then you have the permission to move forward into utilizing options and leverage, and you can then grow accounts very, very, very quickly. Right? So that's a quick explanation. Questions, throw them out there.